Banks are the #1 motivated sellers in today's current economy, bar none. Okay, they're easy to find. Every bank in America has loans in their portfolios that are non-performing, that they're willing to sell to real estate investors. There are over 4,300 banks and savings and loans on the watch list. The FDIC has shut down 83 banks this year alone. There's been a total of 251 bank failures since the start of this recession. You know what caused these banks to fail? It was the collapse of the housing and now the commercial market. That's what's caused the failure, and these banks are who you should be marketing to. Distressed banks are who you should be marketing to in this market. These banks are the #1 motivated sellers, bar none, during this economic crisis that we're currently experiencing. What that means is you need to become a distressed real estate investor so you can take advantage of the bank's misfortune. See, banks have non-performing loans, performing loans, and REOs that they're willing to sell to real estate investors like you for 40 to 70 cents on today's value. You should be dealing and buying directly, exclusively from the banks. See, the real estate market is not as friendly to us as real estate investors as it used to be. It's changing, and it's changing fast. You need to adjust your strategies to reflect what's going on in today's market. It's because your local government, that's right, the legislator, they're writing laws every day that are aimed at real estate investors, and it's not good. That's right, if you're a real estate investor, you got a giant target with a bullseye on you. It's getting harder and harder every day to make money the old way and using the old outdated strategies that were developed for prospering markets. See, we're in a slow, depressed market. It's depressed, it's slow. Everything is upside down, and you need to get a discount on today's value in order to make a profit. You need to be dealing directly with banks. And if you continue to do business like every other real estate investor, you're not going to make it for very long. You need to be dealing and buying directly with the bank presidents, the vice president, and asset managers so that you bypass and overcome the obstacles that's going to put a lot of hardworking real estate investors out of business. I see the economy needs real estate investors to turn this thing around. But you got to keep your eyes open for these opportunities because banks now are more willing to sell the notes before the property goes into foreclosure. I think we got about 3 to 4 years, okay, before this opportunity is going to go away.
Hey everyone, hedge funds are planning to make big real estate profits, and really the reason behind this video is in 2013 there's been a lot of Wall Street money, so the big money, including hedge funds but also other private funds for buying residential real estate. And so sort of the big kind of context or setting behind all this, why this has happened is, of course, with the big downturn, the Great Recession, there was one of the main causes was the housing sector, and there was an oversupply, overbuilding, a lot of speculation, and there was, in many markets, there were a massive number of foreclosures. So banks and mortgage companies have been taking huge numbers of properties back, and that, of course, as we all know, catapulted and cascaded into a worldwide recession, and it affected all sorts of other areas. But this huge housing surplus caused the problem because a lot of these banks had all this inventory, and banks want to have loans with people making payments on loans. They don't want to have inventory of vacant houses. If they were to put all these houses on the market, which they started doing, then you're going to basically decrease the prices of houses in these markets. And so even without releasing all of those, a huge inventory of houses that were not released, but even the houses they did release had a big downward pressure on prices because there was all of a sudden a much bigger supply of houses for sale than there were buyers. And so a lot of buyers were getting out of the market too, just from the fear of the downturn. So it's sort of a spiral. But one of the positives was because the prices went down so much, the income or the rental income on these properties didn't necessarily drop with the prices. It was more of a financing thing then, and so people still had similar incomes and were still making rent payments and sometimes even increasing in rent, and so the income to the price ratio is actually really good. And so we as investors look at that rental income as one of the most important reasons to invest in real estate. And so here's the situation. You have banks who have a lot of vacant houses. Remember, they don't like vacant houses. What do they want? In this situation, what they're really needing is cash. They would rather have cash money. They have regulators knocking on their doors saying, hey, you need to have more cash on your balance sheet. You have all these houses, And the risk if you have too many houses and bad loans and not enough cash is you'll get shut down as a bank. So this is a survival type game that banks are not happy with the houses. They would be happy if they had more cash. But remember the problem? They put all their houses on the market and liquidated them. They'd get lower and lower amounts of cash, and it could lead to them having even bigger problems. Well, at the same time as these banks have this problem, you have a lot of people with private funds, very wealthy people, or big managers of big funds of money. They have money sitting in cash. The interest rate picture's out there. Interest rates are very low. So interest rates are low, or historically low. In the less, if you're sitting in a CD or money market, you're in the less than 1% range. So they would be very happy with something like real estate that produced a good income. And so this is the general context what made sense. If there's a way for this big inventory of houses to go to in bulk to private funds who had the cash and were willing to build a business of owning investment real estate, they could basically just trade places. And so that's the thing that led to the strategy on all sorts of sides. The government was and Fannie Mae, Freddie Mac, and they all put this together. That this is a way to transfer the housing inventory to bigger funds with money who are willing to hold them and rent them. And so the strategy was, right now the funds are going to buy the houses at a what they see as a relatively low price, historically or compared to what they were worth before. And here's the key: they hold them through the storm, or through the period when prices might recover to what they were before the downturn. And so until the inventory levels can stabilize themselves, and in the meantime they collect rental income. And remember, that was one of the big positives of this whole situation. And then in the future they exit and get out, and they sell into a better market, and they don't sell to other investors, they sell to retail users who will like the house and get a loan and buy them out at a higher price. So that's the strategy: buy, hold for 5 to 10 years. So this is more of a short-term hold, and then sell in the future. I'll give you a real example. So let's say before there's a house, just a simple single-family house. 2007, it sold for $160,000 to a homeowner who moved into the house. 2010, they were foreclosed on. And because of all this stuff talked about, the value today on this REO or foreclosure property was only $120,000. But it did have a rent of $1,200 per month. So this is why the hedge fund or the private fund would be interested. So the bank sells the house, they get the cash, and they're actually going to do this in bulk, of course. Instead of one house, it might be, this hedge fund is trying to buy 10,000 houses, raising $1 billion and to buy a bunch of houses. But this is just one to show you an example of what each one would look like. And so this hedge fund might have a cost of $120,000, and the rental income is $1,200. But as we all know, there's expenses involved in renting properties. And so let's say they had a $450 in taxes and insurance and maintenance and management and and vacancy costs. And so let's say they netted $750 per month. And for 12 months, that would be $9,000 per year. So if they had no debt on the property, the net operating income tells you what they would net in this one little house if they just had no debt. So this is the bottom line income figure from renting the property, $9,000 per year. And so this is the profit number one they're looking at, is the operating profit of $9,000. And if you divide that by $120,000 to try to get a yearly return, that's actually about a 7.5% return just from the rents. And to put that in comparison, you remember if you put it in the stock market and you try to get dividends, that sort of income, then you might get a 2 to 3% return. You've also have some growth in some other other ways to make money in the stock market, but we're just talking about income here. And, bonds, maybe you could do a little bit better, but you're still looking anywhere from 2 to, on the most secure ones, up to 6% maybe, if you're lucky. So those are the kinds of returns just from the income. That's a really attractive number to make it worth their effort to do what has traditionally not been done, because there's a segmented market. There's a lot of houses spread out all over the place, and typically big money has bought real estate that is in one big complex, like one big apartment complex or one big commercial building or commercial complex. And so, but it made it worthwhile to try to look into aggregating all these houses. But that wasn't the end of it. So the bigger profits, and the reason that 7.5% by itself would not be good enough for the house was worth 160 originally, and they had a cost of 120,000. There's another $40,000 in value, potential appreciation value, which they could sell. Eventually, they might be able to sell it for something like that and get a capital gain. And so that's $40,000 on their 120,000. When you look at this whole picture, they have two different places. The real yield they're looking at is maybe a 12 to 15% yield without leverage. And a lot of these funds use some leverage. You have the ability to borrow cheap money. They might use leverage, and a lot of them are looking at a 20% plus returns. So this is really what they are looking at, what the bottom line of what the fund managers, what has attracted them. Because this is such a massive opportunity scale-wise, and you see it more as a opportunity to get in big. And so if you're watching this video, and just really show, if you're interested in this model of buying and holding properties for this period of time, nicer houses and nicer neighborhoods, where you buy low, you rent it for a period of time, in the future you sell it at the right time in the market, and sort of be a cyclical kind of real estate investor, this model of buying and holding for the short term, and so you can learn how to make profit in today's market. So thank you for your time. Really appreciate your time watching this video.
I was able to identify a bank that had 59 bulk REO assets that they were trying to sell. I called the bank and I said, Mr. Banker, I'm interested in buying that package of homes that you have. I know that you guys are motivated sellers. You've owned this package of homes. They've been listed on the MLS for the last 6 to 9 months. I know you guys really want to get rid of this package. He said, yes, we do. Give us your highest and best offer. So what I did is, I went and I ordered some AVMs. AVMs are automated valuation models. It's just something like a BPO, but it's less expensive. They don't go out there and physically inspect the property. It's just a desktop evaluation. That's pretty much all it is. So I ordered my AVMs, and after I got back my AVMs, I realized it was a good package. And I was interested in maybe moving forward with trying to present this banker a deal. So what I did is I called the banker and I said, yeah, I'm interested in buying this package. How much you want to sell it for? So the banker said that I could buy these properties for $2 million, but my evaluations had determined that it was worth at least double that. I thought that the value of the package was at least $3.5 to $4 million. So even at the $2 million mark, I was still going to be able to buy for 50 or 60% of the market value, which is actually not a bad position to be in. But I like to get closer to $1 as possible. That means I want them to go down in what they're asking for the package. So what I did is I told the banker that I'm very interested in taking on the package and that we can close quickly. Now you also got to realize that whenever you can close quickly, that's going to give you leverage. Whenever you're dealing with banks, whenever you're dealing with motivated sellers, it's going to give you leverage because they know that you have cash to close. The bank asked me, well, how fast can you close? I told them 21 days. I had a few more deals that I was working on at that particular time, and I'm just going to let you guys know. The bank was Mercantile Bank, and that's who I bought this package from. That worked, and this deal worked for me. So I was able to get them down to $1 million after negotiations with this bank because I was willing to prove that I could close with them fast. So this is when the conspiracy starts to happen. The next thing that I was able to do is I was able to negotiate with the banker that he wouldn't allow, that he did not need my earnest money deposit for 5 to 7 days. Now take this into account that most of the time when you're dealing with bankers, when you're dealing with these asset managers from these different banks, they're going to want you to put down at least 10 to 20%. So if he was requiring for me to put down 10 or 20%, that would be $100 to $200,000 that I would need to put down just to tie up this contract. But I was able to negotiate with him that he would not mandate that my money be in the escrow account for at least 5 to 7 business days. And I made it business days instead of days because when you run into the weekends, that can buy you some extra time for you to hit the phones real hard to try and find people who may be interested in buying this package from you. Now, I knew the package was worth at least $3.5 to $4 million. I was able to negotiate it for $1 million. Immediately what I started to do is, after I was able to get this commitment from the bank that my earnest money deposit was not going to be required for another 5 to 7 days, I put my attorney on it, and he was able to execute a contract with the bank. So I executed a contract. Now, again, that this is a dry closing deal. It's dry closing because I don't have any hard money invested out of my pocket at all. I don't have a dime. I mean, when I say a dime, I don't have any money whatsoever, not even a single dollar. So I didn't have to come out of my pocket. You know, some strategies teach you how to come out of your pocket. You got to invest money. It's either your cash, or you got to invest your credit cards, or you got to invest something in it. In this particular package, I didn't invest any money at all. And these are the kind of strategies that you need to learn so that you can be a part of this arbitrage conspiracy as well. So now that I had a package of homes that was priced right, I immediately got on the phone with buyers. It took me 3 days to find a buyer. Now listen to me very closely. Here's how I structured this deal. And you're going to learn more when you download this free report. I was able to find a buyer who was interested in buying this package from me for $1.4 million. This was going to allow my partners and I a profit of $400,000. Just imagine what $400,000 would do for you right now. Just imagine. $400,000 on one deal that took me maybe a month to structure, from the time I found the package to the time I was able to get the deal closed. So what I did is, I told the buyer that he needed to provide me with $100,000 in 3 days. Okay, you guys listen in. I told the buyer that he needed to provide me with a $100,000 deposit in 3 days, deposited into my escrow account. And I did that because I had 7 business days in order to deposit the money in the account, or the bank was just going to tear up my contract and put it in the garbage. So because I was able to find a buyer to put up the $100,000, that means that I didn't have to put the money up. So this is when the conspiracy starts to happen, because this is a strategy that those conspirators out there who are using the arbitrage conspiracy are using right now to make deals. So now I had a buyer that was ready, willing, and able to put his $100,000 into an escrow account, and I used that $100,000 in order to comply with the bank that I had it under contract for. Ha-ha. Now you guys are starting to realize how this works. Now, I got under contract for $1 million. My buyer's buying it for me for $1.4 million. The next thing I did is I built a relationship with a transactional funding company who was willing to put up the money so that I can close out with the seller, which is the bank. So I was able to complete the A to B transaction, and then I was able to get the buyer to wire his funds into the account, my escrow account, to close the deal so that we can complete the B to C transaction, which was from me to the buyer. So in that deal, I was able to put in my pocket $400,000. And when it was all said and done, after splitting profits with my partners and legal fees, I was able to make $174,037.50 on one deal. That is why this is the best niche that I know of that allows you to make not just small profits, but big profits. And that's why the conspirators don't want you to know about it.